Thank you for joining us at xm.com for today's market comment by Marios Hadjikyriacos. I'm Maria Pachordiz. The final quarter of the year begins with familiar themes in global markets. A relentless rally in U.S. bond yields, driven by increased debt supply, renewed concerns about China's economic health, and a sinking Japanese yen continue to dominate the agenda for traders. Gold absorbed significant damage last week, falling sharply to hit its lowest level since March as it started to realign with its gloomy fundamentals. For months now, gold kept defying the downside pressure exerted by soaring real yields and an appreciating U.S. dollar, as sovereign purchases by central banks offset some of the selling pressure. It appears that central bank purchases have finally dried up, leaving gold to fend for itself in an environment of sky-high real yields. The result was a catastrophe, with bullion losing 4% of its value in a single week. Precious metal extended its losses on Monday, following a last-minute political deal to avert a U.S. government shutdown, which helped calm some nerves in the markets and lift Wall Street futures. That said, this bill will fund the government only for 45 days, so investors will see another replay of the shutdown movie in November. In the FX complex, the Japanese yen continues to bleed. The yen fell to its lowest levels in a year against the U.S. dollar on Monday, after the Bank of Japan once again intervened in the bond market to prevent Japanese yields from rising too much. Even though dollar-yen is now trading just below the 150 level that triggered FX intervention last year, the risk of intervention seems lower this time. In China, the latest business surveys were mixed, with manufacturing showing signs of bottoming out, but the services sector losing further steam, keeping investors on the defensive. Despite a PCE inflation report that was slightly colder than expected on Friday, dimming the prospect that the Fed will raise rates again, the U.S. dollar still managed to close the week with impressive gains. Euro-dollar has declined for 11 weeks now, as differentials in economic growth and interest rates increasingly turned in the dollar's favor. The American economy has been shielded by the government's massive deficit spending and the slower transmission of high interest rates thanks to fixed-rate mortgages. But Europe is feeling the burn of adjustable rates and elevated energy prices. As for today, the spotlight will fall on the ISM manufacturing survey, which will be followed by some remarks from Fed Chairman Powell. Thanks for watching today's market comment here at xm.com.